We had a fairly mixed week in the market, with red right across the majority of the Mag 7, but other industries have actually started to perform fairly well, and we're now in a space where the Mag 7 valuations are at their lowest since January 2023, more than 2 years ago, but we also need to understand that we could see during this earnings season some revisions which will in essence change these valuations. But if we just look at the market in terms of the forward P, we are noticing there are still many companies, even with the drops we've had from the geopolitical tensions, showing severe overvaluations. Yet Google is not one of those. In fact, it's trading at a forward P around the 15 to 16 region. So is it warranted to be trading this low, or are we actually looking at such an incredible opportunity and one that has become too cheap to ignore? Something we're going to cover in the episode today. And also nice to see that whilst we're still sitting in extreme fear at 21, this has been a lot of improvement from over the last few weeks where we've been in the low single digit. But today, as we said, under the spotlight is Google, which is down 3% over the last year. Year to date, down 20%. So bear in mind, just in 2025 alone, they have lost 1/5 of their market cap. But if you've been a longer term shareholder, well, over the last 10 years, you would have, as we're about to show you, massively outperformed the S&P, up 427%. Trading near its 52-week low, quite a pullback from its all-time highs at $207, and both Seeking Alpha and Wall Street call this company a buy. In fact, it's nearly 4.5 rating that would flip this into a strong buy rating, with a yield at 0.53%, a forward P as well. Both of these we are going to cover and discuss in our own opinion. And when we take a look at the forward valuation at 17, it's lower than the 5-year at 22.2, but also one of the lowest, if not in fact the lowest forward valuation it has been over the period. This is what we would call a severe undervaluation signal. We then also want to highlight the comparison against the 5-year in terms of this methodology. What we can see here is the blue tunnel, which signals the expected fair price. First thing to note, nice to see it increase over time. This is always what we want to see in any company we're invested in or considering to invest in. But what we really want to highlight right now, there is disparity between where the company sits and even the lower end. This is again another massive severe undervaluation signal. But do bear in mind, we're going to run it through our own discounted cash flow model towards the end, so we're not looking at any of these models in pure isolation. Now, the first bit of news that we did get just last week is that the company is facing a $5 billion lawsuit, and this is from the UK. Remember, this isn't the only country that has started to bring some of these charges, some of these lawsuits, but in essence, it's for a near total dominance in the search. In fact, we can see here the competition regulator found that 90% of all revenue in the market was earned by the company, and they're essentially claiming that Google have been abusing their position to restrict competing search engines. And if we just take a look at a little bit more of the detail to understand truly what the issues are for those who are claiming, it's that UK businesses as well as organizations, big or small, have what they believe almost no choice but to use Google ads to advertise their products, their services, and therefore Google has been leveraging their dominance in the general search market. Again, remember, this is something we've also seen in the US, and the claimants essentially want the company to be held accountable for their unlawful practice as well as seeking compensation. That is where we did get to that £5 billion, $6.6 billion. And we can also see the same thing from the US just the day after, where it says here that Google holds illegal monopolies in advertisement. So we can take a little bit more look at the detail, but again, the premise is pretty much the same as what we just noted from the UK. Google illegally dominating 2 markets for online advertising technology, and the US antitrust prosecutors want to seek a breakup of their advertising products. And again, very similar to what we just read, but they're being held accountable for willfully acquiring and maintaining monopoly power. UK, as we said, did claim it to have more than 90%, something that we will discuss, but remember, this is why we always have to use a margin of safety when we get to our valuation. And we can see as well the US Senate Elizabeth Warren as well saying it's a time now to break up the tech giant. So a lot of people are really gunning for this company, and we will find out in the near future exactly what the conclusion will be and the impact it will have on the company. And we can see also the Department of Justice arguing the exact same thing, that a major huge breakup is needed to prevent this ongoing monopoly, and they've also said they've rejected Google's proposed remedies, which they're saying is anemic, and they actually say it's also a false theory, where Google have said their multi-billion-dollar default status deals have no negative effects on competition. Again, up to you whether you consider this to be factual or not, but the main thing here that we really want to point out is that there are some issues that Google are now going to have to face, and we will very soon, as we said, get to our conclusion. In fact, if we just take a look, there will be a 15-day evidentiary hearing, and it'll be starting April 21st, so in just a few days' time, and we'll also hear from the Google CEO himself, as well as many others in the company. And one of the proposals, as we saw in fact from last year, is the potential divestment of both Chrome as well as Android. Now, we've also gone into quite a lot of detail in previous episodes, where even analysts believe right now, baking in all of these issues, considering a breakup, the company does look extremely undervalued. As we said, we will get into this as well. But one thing we wanted to point out, as super investors are starting to show their portfolios for the latest quarter, that would be Q1 2025, we have Alphabet here, so just bear in mind, we're going to take a look at super investors. Some hold GOOGL and others hold the other ticker symbol GOOG. They're essentially just the same company, but different voting rights. Now, what we've noticed in the most recent quarter, again, these are just a few that have come through. Super investors are looking at trimming their position in the company. Not massively, but again, just something to bear in mind. And we can see the exact same with a few others when looking at the other ticker symbol, although we do have Robert Olmstein, who actually has gone against the grain and added around 3,500 shares. But again, in terms of his own portfolio, it isn't that much. 0.1%. When we do get other super investors, and maybe those that you look more towards, whether that's Warren Buffett, Bill Ackman and others, we will bring it to your attention, so make sure you are subscribed to the channel. But we also want to point out, this is a company that is one of the most held by super investors, so whilst we have seen a little bit of trimming at the moment, we will be very surprised if we don't still see it in those top positions. Now, given we've just looked at super investors, probably best then just to go straight towards the institutions, and they hold around 40% ownership. They sold around 49 billion worth of shares in the company over the last year, but they bought nearly twice as much, 89 billion, so still very bullish on the company. And we also want to point out, based on the most recent data set that we have now just got for Q1 2025, we can see that institutions have bought a lot more, in fact more than 4 times at 4 billion in the latest quarter, 741 million shares sold. So very clear and obvious over the last year and in the most recent quarter, institutions very bullish on Alphabet. If we do the same but we look at insiders, they hold around 12% ownership, 103 million worth of selling just over the last year. But this is something that has been very consistent by, in fact, insiders. It is a trend that we do see every single quarter, and we also do want to highlight that insider selling isn't necessarily a bearish signal. They sell for many reasons, personal and financial, but we'll also show you, for those that want to see and for full transparency, the most recent selling, in fact the most notable one, CEO on the 2nd of April, sold 32,500 shares, netting him just over $5 million. Again, information is here, as we said, not something we would use, but if you want to, you can take a look. Now, going back to the valuation of the company, whilst they do get a D-, as we said, they are trading around the 16 mark on a forward P. They are above the sector at 12, so you can see they are getting a 43% premium, but you could argue, in fact, in the communication sector where it has been put in the bucket, maybe this company doesn't deserve to be there. And we'll also show you, if we are comparing it to this sector, they are worth that premium. Their metrics are a lot stronger, and we also notice, as we've just highlighted, they're trading around 33% lower than they have done over the last 5 years. This is what we would call, again, an undervaluation signal, and something that is noted no matter which valuation metric you look at, they are trading much cheaper than they have done over the last 5 years. Doesn't mean we should buy because they're cheaper. There may be reasons for that. There are considerations that we are running through in this episode. And it's also worth noting that in the most recent quarter, their top line revenue was up 12% year on year. We also got some nice efficiencies to their margin, 1 percentage point on the gross, 5 on the operating, and 4 on the bottom line, whilst also noting growth in their search advertising at 13% year on year. Remember, this is one that analysts have said is starting to die out, yet just in the most recent quarter, we got the double-digit increase. YouTube up 14% year on year, and their fastest growing revenue stream, which we'll also touch upon, their Google Cloud up 30% year on year. So nothing at the moment that we would say is a red flag indicator. And also they're expecting growth to continue to the EPS over the next 4 quarters with a 100% historical track record based on the last 4. And if you want to look towards December 2026, their next full accounting period, they're trading based on those numbers at a forward P of 14.9, but we should see in their latest earnings over the coming weeks if there will be any revisions, which will obviously affect these valuations. The other thing to note as we go along the episode today is that the reason why this company is getting hammered when we are considering potential losses in their search advertising is that it makes up 57% of their total revenue. So as we will come on to show you, their revenue in fact for 2024 was 350 billion, up 14% from the previous year, and as noted, 57% of that is coming from the search, which is in effect a very large percentage. Now, as we have done typically on this channel, we can in fact see in terms of the standard search engine, when we do look at the percentage of the market cap, we can see 10 years ago, Google did hold around 92%. As we keep going moving forwards, whilst it has decreased slightly, it is still fairly strong at just under 90%. When you look at the second closest competitor, you are looking at Bing, which is around 4%. But if you just go and have a look on the internet and you search on Bing, the most searched thing on that platform is in fact Google. We understand it isn't this classic search engine that is coming under fire. In fact, it's against those like ChatGPT. And if we are just to take a look, this is ChatGPT versus Gemini, which is Google's own search engine, very similar. And MAU, standing for monthly active users, over the last 2 years, what we have noticed, ChatGPT has only been increasing at a very large rate. With Google, we don't get that same type of growth, and that is something that investors, analysts are considering, and that is perhaps why we are seeing the share price of this company suppressed at the moment. And it's always great to bring this article back up because it talks about Googling, how it is essentially for old people. It says that the problem with this is that the younger generation are no longer using the search engine, and in fact, they are moving towards ChatGPT. But not only that, there are also other type of platforms like Grok and many others, and they actually believe this was released towards the end of last year, that Google is the Titanic in the hours before it struck an iceberg, riding high, supposedly unsinkable, and about to encounter a force of nature that could make it synonymous with a catastrophe. And no surprises, they are talking about their core business, as we saw more than 50% coming under siege as people are increasingly getting their answers from artificial intelligence. In fact, here they do pinpoint the younger generations, and it would be good to understand from the community whether or not this is something you yourself have been moving away for. Do you stick with platforms like Yahoo, maybe Bing even, or are you moving away to the ChatGPTs for your search queries? Now, as we did show you earlier, their fastest growing revenue stream is in fact Google Cloud. Very impressive if we just look at 2024. On average, it is around the 30% for this income stream, which is very strong, especially when you compare it to AWS, which in fact is the market leader, because they are not growing at that rate, sitting around 18% on average for 2024. And as we can see, they are in fact number 3 in terms of market share, 12%, not just behind AWS, the global market leader, but also behind Microsoft Azure, sitting at 21%. And what's good to see is the industry as a whole has grown around 22% on a year-on-year basis, so there is a lot of opportunity for Google to maximize this growth income stream, and they definitely believe this is something they should focus on, because if you missed it, it was just a few months ago where they did announce their biggest acquisition ever, and that is with security, 32 billion in fact, and this is expected to increase their top line revenue for Google Cloud, making more businesses come towards their platform, as it will help with the security and therefore attract more customers. We also want to flag it's only recent that Google Cloud in fact has become profitable. You'd have to go to the beginning of 2023, but nice to see with the growth of their top line that also follows their operating income, whereas AWS is a bit more mature. In fact, going back as far as 2019, we can see not just revenue but also an operating income. And there are other things to consider with a company. A lot of people always think about Google and think straight away at their search engine, but we can also see here YouTube up 14% year on year, bringing around 11 billion worth of revenue. But as we do have to point out, when you compare it against their total top line, we are talking around 10 to 15%. Nonetheless, just around 4 years ago, it was bringing around 3 billion. Now it's pretty much tripled just over the last few years. And why we do like this, and we do believe this could be an opportunity that they can start to exploit, start to increase for shareholders, is because if we just look at last month, March 2025, and we take a look at in fact what consumers are taking in, the vast majority on TV is streaming at 43.8%. And who is the number one on the streaming platform? It is YouTube by quite some distance at around 12%. In second place, Netflix at 7.9%. So more people watching, consuming their videos, essentially meaning more advertising revenue. And we can see this is something that's only been increasing over the long term. So if we do in fact go back 2 years, it was around 7.8% of streaming time in the US, now sitting at 12%, something that we haven't seen as much growth for the second place, Netflix at 7.3%, now sitting at 7.9%. So it does look like the world is moving towards consuming a lot more in terms of YouTube and less in terms of the typical cable. And we can see here when we look at advertising for Google search and YouTube in combination, by quite a significant way, they are taking in a lot more money than the likes of Meta as well as Amazon. And bear in mind their capital expenditures are quite significant, only increasing on a year-on-year basis. In fact, in FY25, they're expected to spend, as we can see, 75 billion, which was one of the reasons why in fact the share price dropped in their latest earnings. Analysts were expecting a lower amount, but as we will come to show you, their ROIC, return on any capital they do invest, is very high, something shareholders will love to know. Now, we've covered YouTube advertising, we've covered a lot of different income streams, their cloud, their search, but one thing that maybe goes under the covers is their other bets, which as we can show you from their latest quarter is fairly small at 0.4 billion, but something we do believe will continue to only get larger and larger as the quarters go on. And we can see in 2026 they will be launching Waymo into Washington DC. Now bear in mind, in 2024 alone they completed more than 5 million rides, and that is something we haven't seen from any other robotaxi competitors. And with the partnerships they're doing with Uber, as well as moving into Tokyo, other countries, we do anticipate this is only going to get stronger and stronger for Google and the business. And there's also something else to consider, quantum chip. We did hear from this at the back end of last year, where they unveiled Willow, their latest quantum computing chip. Now we do understand, as noted here, we are quite some way from seeing this come into fruition, being useful and turning this into generating income, but it is something that is on management's radar. And we can see from just a few days ago, there was a little bit of a deeper dive into understanding how this can come into fruition, how they can effectively take this as something tangible. But the main user case right now is that they believe this can take a benchmark problem and solve this unimaginably faster than what's possible right now from the classical computer. And they talk about how this could be used to turn research into a commercial opportunity, especially as AI hits a data wall. But again, just something to know. And if we just run through some of their underlying metrics before getting to our valuation, we always like to look at free cash flow over earnings data because it is susceptible to manipulation by management through accounting. But free cash flow, we want consistent increases over the long term, something we do get from the company, and in fact a small increase is noted over the next 12 months. Sales growth, very, very impressive. In fact, out of the last 10 years, 9 of them have been double digit. Now 2024, most recent year, as highlighted, up 14%. And we can in fact see this when we look at the total sales on a numerical basis. Very impressive to see their top line has grown in fact more than 4 times over the last 10, whilst also doing share buybacks. And actually remember, this does return excess cash to investor pockets, something that they have done over the last 10, but actually quite aggressively just over the last few years. So we do believe management are now seeing this company as being undervalued. They do see a lot of opportunities to buy back shares, which is nice, especially given they have just recently also introduced a dividend. ROIC, one of our favorite metrics, 10% or more. Give us faith, management are able to effectively allocate their capital, not only above that 10%, but increasing. Nice to see 26% in 2024. And if we then move on to the margins, now for those that are maybe newer to the channel, we don't just want to see companies that are increasing their revenue, but we also want to see them improving on their margins. That is what we would say criteria for high quality companies, something we do see from Google, not in fact just above the minimum 12%, but increasing from 26 to 33 in 2024. And free cash flow margin, very consistent, well above the 5%. You could argue, in fact, a free cash flow machine. Probably our favorite metric yet, the net debt to EBITDA. The below is the number of years it would take the company to pay off all of their debt net of cash on hand. Below 3 is what we want to see. Correlates to balance sheet strength. Now look, over the last 10 years and over the next 12 months, it won't even take the company one day to pay off all of its debt net of cash on hand, an extremely strong balance sheet and something we will also show shortly too. Now, as we touched upon earlier, we also want to compare it against the sector, and their growth does come at a B. Year-on-year revenue up 14%, forward-looking estimated 12, well above the sector at the low single digit. Remember, we did say it deserves a premium to the overall sector, but one thing we do have to point out, they have been growing a little bit slower than they have done over the last 5 years at 18 and 15% respectively. Yet they do anticipate earnings per share to grow 15% over the next 3 to 5 years, a lot higher than the sector at 9.8, a little bit lower than their own 5-year at 17.9, and profitability comes in at an A+, gross margin 58%, a lot better than the sector at 53, above their own 5-year in fact at 56, and bottom line 29%, well above the sector at 4, but also well above their own 5-year at 24.5, so we are seeing efficiencies, something we always love to note, and we can also see they've generated a mammoth amount of cash from operations, 125 billion over the last 12 months, significantly above what they have done over the last 5 at 89 billion on average, and completely above the sector at 326 million. Now we will point out that over the last year they haven't performed that great, they are down around 2%, but we can also see, for example, Meta hasn't performed that well either, up only around 2%. If we were to zoom out over the last 5 years, up 138, one of the better performing, Meta although taking the edge at 181, and over the last 10 years again up 430%, a little bit below Meta's 520, but it will show you massively outperforming the S&P. But do remember, past performance is not an indicator of the future. As we said, we'll show you the performance against the S&P, where they have marginally underperformed over the last year, -2, S&P +5. Over the last 5 though, that is where things start to take off, up 138, S&P up 84, and over the last 10 years up 430%, massively outperforming the S&P, up 150. Now remember, we did say their top line revenue growth is very impressive. We do love that growth from 75 billion 10 years ago to now sitting at 350, but what we really want to highlight here, what does the bottom line net income tell us? What is the story? Is it as consistent? And the answer is a pretty much yes. In fact, it's gone from 16 billion 10 years ago to now sitting at 100 billion. In fact, the first company to report 100 billion on the bottom line net income. Very impressive and something we love to see as investors. We then finally take a look at the health of the company, a quick total cash versus total debt analysis. Now cash has increased, although inconsistently, at 72 billion, now sitting at 96. But as always, one number here in pure isolation will not give anything away, so we compare it to their total debt numerically and directionally, which has increased in fact over the last 10 years. It's gone from 8 billion in 2015 to now sitting at 28, but as we just highlighted in fact not long ago, it won't even take this company one day to pay off all of their debt net of cash on hand, cash balance far superior than their total debt. Now just before we get into the valuation, we want to let you know we have released our latest free weekly article. We drop on every single Monday morning where we cover severely undervalued stocks as well as what's going on in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to grab a copy of 35 severely undervalued stocks for the month of April, lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that you can grab a recently released copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, sign up, and you can read straight away. Now we're jumping into our valuation where we get to $226 derived from the DCF model. Now we'll show you we have the free cash flow year on year, including 2024. Average growth has been 20% year on year over the last 10. Moving forwards, we have gone 12%, as you can see, low, medium and high. Do remember, numbers here are subjective. You can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Alphabet or any others. So based on 12% and the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, 226, indicating 50% upside. Now look, full transparency, we will show you for those that believe that is way too high, at 10%, $197, upside of 30%, and for those that believe we should be more bullish, well 14%, 259, 72% upside. As we typically do on the channel, we will take through the medium rate, where we're not just done there because we always like to apply an MOS, where we kick things off at 10%, we execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. Now, if we believe that in today's episode, a buy at $203, then we keep going till it's near the current trading price. And in essence, what we're saying right now, not a 35% MOS just yet, but for Alphabet, you're getting at least 30% up to $158. And Wall Street themselves believe this is a $210 stock over the next year, in turn translating to 39% upside. So what are your thoughts? Alphabet, 30% MOS, 39% upside. Do you see it as a buy, hold, or sell? And we'll also run through the MOS for those that believe we should use the 10%. You are still getting quite a nice healthy point here. At 20%, a buy at 157. At 25, not quite there yet, but not far off. So if you do believe they can grow their future free cash flows at 10% over the longer term, you're getting a near 25% MOS with Wall Street themselves, as we said, 39% upside. And we'll even show you for those that believe we should go even lower at 8% to again show you are still getting a margin of safety, pretty much not at 10%. In fact, you're getting near 15, sitting somewhere, so we should say 10 to 15 with Wall Street themselves, 39% upside. Again, this is for those that are fairly bearish, see 8% growth when over the last 10 it's been 20 year on year. But as we said, even at the 8%, you're getting more than a 10% margin of safety, and Wall Street see this at 39. So give us your thoughts. Do you see Alphabet as a buy, hold, or sell? And don't forget to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon where we cover our weekly buys and sells, and have a great day. We'll see you all on the next one.